When people think about financial collapse, they picture stock market crashes, bank runs, or housing bubbles bursting. But lurking beneath the surface of global finance is a shadow market so vast, so interconnected, and so dangerously complex that it makes the 2008 crisis look like a warm-up act. We're talking about a $600 trillion derivatives market that has grown like a cancer through the world's financial system. And if history teaches us anything, it's that the bigger they are, the harder they fall. Let me put that number in perspective. $600 trillion is more than 12 times the size of the entire world economy. It's roughly double the gross domestic product of every nation on Earth combined. This isn't money sitting in vaults or accounts. It's a web of financial contracts, bets, and promises so tangled that no single institution fully understands its scope. And the people managing this colossal machine think they can control it forever. They're wrong. The year 2026 is shaping up to be the moment when this house of cards comes crashing down, not because of some random black swan event, but because the mathematical certainty of boom and bust cycles is converging with the most dangerous financial experiment in human history. Every empire that thought it could outsmart the laws of economics has learned the same brutal lesson. The only question is whether we'll heed the warnings before it's too late. Here's what makes this different from every other financial crisis you've heard about. In 1929, the problem was leverage and speculation in stocks. In 2008, it was subprime mortgages and housing derivatives. But today's derivatives market dwarfs both of those disasters combined. We're looking at a notional exposure that has doubled every 2 or 3 years for the past decade. Interest rate derivatives alone reached $579 trillion in 2024, their highest level in 10 years. The word notional is crucial here because it reveals both the scale and the deception. Most of this isn't real money changing hands. It's the face value of contracts that reference underlying assets. Think of it like insurance policies. If you insure your house for $200,000, that's the notional value. But the actual premium you pay might only be a few thousand. The problem comes when the house burns down and everyone expects to get paid at once. In the derivatives world, that house fire is coming in 2026. The mathematics behind this prediction aren't mystical. They're based on economic cycles that have repeated for centuries. Economist Fred Foldvary, who correctly predicted the 2008 crisis, has identified an 18-year business cycle in the United States. That cycle points directly to 2026 as the year when the next Great Recession hits. But this time, the underlying vulnerabilities are exponentially worse than they were in 2008. Back then, the derivatives market was already dangerous enough to nearly collapse the global financial system. Credit default swaps, those infamous instruments Warren Buffett called financial weapons of mass destruction, helped bring down Bear Stearns, AIG, and Washington Mutual. The total notional value of derivatives in 2008 was around $600 trillion, roughly the same as today. But here's the terrifying difference. In 2008, the United States government could still borrow unlimited amounts to bail out failing institutions. By 2026, that safety net will be gone. The US national debt will have grown so massive by 2024 that American bonds will no longer be considered the ultimate safe haven. When the next crisis hits, the Federal Reserve and Treasury won't have the fiscal firepower to rescue every failing bank, every over-leveraged hedge fund, and every interconnected financial institution. The bailout mechanism that saved the world in 2008 simply won't exist anymore. This creates a feedback loop that amplifies every risk in the system. When institutions can't be bailed out, they fail. When they fail, their derivatives contracts become worthless. When those contracts fail, the institutions on the other side of the trade face massive losses. And because every major bank is connected to every other major bank through this web of derivatives, the failures cascade like dominoes. Consider the concentration risk alone. JP Morgan Chase holds roughly $58 trillion in derivatives exposure. Citibank, Goldman Sachs, and the other major players hold similar amounts. These aren't small regional banks that can fail quietly. These are the pillars supporting the entire global financial system. And they're all betting on each other's survival through derivatives contracts that assume everyone will be able to pay when the bills come due. The netting process that supposedly reduces risk only works if all counterparties remain solvent. It's like a game of musical chairs where everyone assumes there will always be enough seats. But when the music stops and one major player goes bankrupt, the careful balance collapses. Positions that were supposed to cancel each other out suddenly become massive one-way exposures. Banks that thought they were hedged discover they're actually naked to enormous losses. Interest rate derivatives represent the largest and most volatile segment of this market. With notional amounts reaching $488 trillion, these contracts are essentially bets on where interest rates will go. The problem is that central banks around the world have been manipulating rates for so long that nobody knows what natural market rates should be. When that manipulation ends, and it will end, the resulting volatility will be catastrophic. We got a preview of this in 2022 when the Federal Reserve started raising rates aggressively. Bond values plummeted, bank balance sheets took massive hits, and derivatives markets experienced violent swings. British pension funds, supposedly conservative institutions, nearly collapsed because their derivatives positions went against them. They were forced to sell assets into falling markets to meet margin calls, creating exactly the kind of death spiral that brings down entire systems. Now imagine that scenario playing out simultaneously across every major financial center in the world: New York, London, Tokyo, Frankfurt, Hong Kong, all connected through derivatives contracts that assume stability and solvency. When one domino falls in 2026, they all fall together. The regulatory environment makes this collapse almost inevitable. The Fundamental Review of the Trading Book, a set of rules designed to ensure banks can handle derivatives losses, has been delayed until 2026 in the European Union. The very year when we need these protections most, they won't be in place. Meanwhile, in the United States, proposals to roll back financial regulations are gaining momentum, weakening oversight at precisely the wrong moment. Mark Mobius, a veteran investor who has seen multiple financial crises, warns that another collapse is inevitable because derivatives remain essentially unregulated. The Dodd-Frank legislation that was supposed to fix the system after 2008 was, in his words, merely a PR stunt that didn't really change anything. The fundamental problems that caused the last crisis are still there, only bigger and more complex. The human cost of this coming collapse will be staggering. Financial modeling shows that a 2007 scale shock hitting today's economy would result in 8.7 million Americans losing their jobs by 2026. Unemployment could rise to 4.6%, and employment wouldn't recover to current levels until 2031. But those projections assume government intervention similar to what happened in 2008. Without that intervention capability, the damage could be far worse. This isn't fear-mongering, it's pattern recognition. Every major financial crisis in history has followed the same script: excessive leverage, interconnected risks, regulatory capture, and the dangerous belief that this time is different. The derivatives market of 2026 represents all of these factors taken to their logical extreme. The question isn't whether this system will collapse. The question is whether you'll be prepared when it does. The warning signs are already flashing red across every major financial center. In 2023, Credit Suisse, a bank that had survived 2 world wars and countless market crashes, collapsed in a matter of days. The trigger wasn't subprime mortgages or bad loans, it was derivatives exposure that spiraled out of control when confidence evaporated. Swiss authorities were forced to engineer a fire sale merger with UBS, but not before Credit Suisse's derivative positions created billions in losses that rippled through global markets. That collapse was a dress rehearsal for 2026. And the lesson is clear. When trust breaks in the derivatives market, institutions that look rock solid can disintegrate almost overnight. The mathematics of cascade failure are brutally simple. When one major counterparty defaults on its derivative obligations, every institution on the other side of those trades faces immediate losses. Those losses force fire sales of assets to raise cash, which drives down asset prices, which creates more losses for other institutions holding similar assets. It's a vicious cycle that feeds on itself until the entire system seizes up. Long-term capital management demonstrated this dynamic in 1998. Despite having over $1 trillion in notional derivatives exposure, LTCM was leveraged at ratios exceeding 25 to 1. When Russia defaulted on its bonds, the fund's mathematical models collapsed, and the resulting panic revealed dangerous exposures throughout Wall Street. The Federal Reserve had to orchestrate a private bailout to prevent a complete meltdown of global markets. But LTCM was tiny compared to today's derivatives monsters. JP Morgan Chase alone holds more derivatives exposure than the entire long-term capital management crisis times 50. And there are dozens of institutions with similar positions, all interconnected through contracts that assume everyone else will remain solvent. The cryptocurrency revolution has added another layer of instability to this already fragile system. What many people don't realize is that the crypto market has spawned its own derivatives ecosystem, complete with leverage ratios that make traditional finance look conservative. Tether, the largest stablecoin, claims to back its tokens with real assets, but those assets include complex derivative transactions that allegedly involve rogue traders and questionable strategies. When the crypto bubble bursts, and it will burst, the losses won't stay confined to digital assets. Major banks, hedge funds, and pension funds have all piled into crypto derivatives, creating new pathways for contagion to spread through traditional finance. The subprime 2.0 crypto bubble resembles the toxic pyramid of credit derivatives that caused the 2007 to 2009 crisis, except this time the underlying assets have no intrinsic value beyond speculative trading. The shadow banking system has grown even more dangerous since 2008. Through leveraged derivatives positions, just 3 investment firms, BlackRock, Vanguard, and State Street, now manage over $20 trillion in assets. That's more than the GDP of the United States. These unelected, unregulated entities make decisions that move the entire world economy, and their risk management depends entirely on derivatives contracts that assume perpetual stability. When stability breaks, and it always breaks, these shadow banks will face the same cascade failures that brought down traditional banks in previous crises, except this time, their collapse will be orders of magnitude larger. Artificial intelligence and algorithmic trading have accelerated the speed at which these failures will unfold. In 1929, it took weeks for panic to spread from New York to London to Tokyo. In 2008, it took days. In 2026, it will take minutes. High-frequency trading algorithms, programmed to sell at the first sign of trouble, will trigger avalanches of selling that overwhelm human decision-making. Market circuit breakers and trading halts won't matter when the underlying problem is systemic insolvency, not just temporary panic. The yield curve, that reliable predictor of recessions, tells us exactly when this crisis will peak. Historical analysis suggests the curve will first uninvert in June 2026, pushing the recession to that precise timeframe. It's not coincidence that this aligns with other cyclical indicators. Samuel Benner's 1875 investment timing chart, which follows an 18 to 20-year rhythm of market upheaval, also points to 2026 as the next major crash year. Multiple forecasting models, using completely different methodologies, are converging on the same conclusion. The business cycle, the debt cycle, the regulatory cycle, and the political cycle are all reaching critical inflection points simultaneously. When that many variables align, the resulting crisis isn't just probable, it's inevitable. The Federal Reserve's own stress test revealed the fragility lurking beneath the surface. Under a 2022 redux scenario, where interest rates spike and bond values collapse, the banking system would face capital gaps exceeding $160 billion. That's down from earlier estimates of over $260 billion, but it still represents catastrophic stress on institutions that are supposed to be the backbone of global finance. And those stress tests assume orderly market conditions where banks can sell assets at reasonable prices. In a real crisis, when everyone is trying to sell at once, asset prices don't decline gradually. They collapse. Fire sale conditions make every position worth less, which forces more selling, which creates more fire sale conditions. The Bank for International Settlements, often called the central bank for central banks, has quietly raised alarms about these vulnerabilities. Their latest reports show that fire sale vulnerability spiked sharply in 2022 and has remained at levels not seen since 2010. The index measures how quickly asset prices would collapse if institutions were forced to sell simultaneously. The current readings suggest that a moderate shock could trigger massive price dislocations across multiple asset classes. What makes 2026 particularly dangerous is that central banks have exhausted their traditional tools. Interest rates in most developed countries are already near zero or negative. Quantitative easing programs have inflated asset bubbles to unprecedented levels. Government debt ratios have reached levels that historically led to sovereign crises. When the next shock hits, policymakers won't have the ammunition they used to fight previous battles. The European Central Bank faces an even more complex challenge. The Eurozone's banking system holds massive amounts of sovereign debt from member countries with vastly different economic fundamentals. Italian banks loaded with Italian government bonds, German banks exposed to Eastern European derivatives, French banks tied to African commodity trades, all interconnected through currency swaps and cross-border lending arrangements that assume political stability and monetary union. When the derivatives crisis hits in 2026, it won't respect national boundaries. A bank failure in Frankfurt will instantly create losses for institutions in Milan, Paris, and Amsterdam. Currency derivatives alone represent $97 trillion in off-balance sheet exposure globally, creating hidden linkages that become visible only when they start breaking. The timing couldn't be worse. Political upheaval across the developed world has weakened international cooperation just when we need it most. Brexit created new fractures in European financial networks. Trade wars between the United States and China have politicized economic relationships that were once purely commercial. The rise of populist movements has made bank bailouts politically toxic, even when they're economically necessary. In 2008, world leaders could still rally around the shared goal of preventing global collapse. Central banks coordinated their responses, governments provided fiscal support, and international institutions like the International Monetary Fund had credibility and resources. By 2026, that consensus will be gone. Every country will be fighting for its own survival, making coordinated responses nearly impossible. The derivatives market doesn't care about politics or good intentions. It operates according to mathematical laws that are as unforgiving as gravity. When leverage becomes excessive, when interconnections become too complex, when confidence breaks down, the system collapses. No amount of hope or wishful thinking can change those fundamental dynamics. And the collapse, when it comes, will be swift and merciless. Institutions that look healthy today will be bankrupt tomorrow. Savings that seemed secure will evaporate. Pensions that were promised will disappear. The social contracts that hold modern societies together will be tested in ways they haven't been tested since the Great Depression. This isn't ancient history or distant theory. This is the mathematical certainty of a system that has grown too large, too complex, and too interconnected to survive its own contradictions. The only question is whether enough people will recognize the danger in time to protect themselves and their families from what's coming. The derivatives market's appetite for risk has created what economists call a doom loop, a feedback mechanism where each attempt to reduce risk actually increases systemic danger. Banks use derivatives to hedge their positions, but those hedges require counterparties who are themselves hedging with other derivatives. The result is a circular chain of dependencies where everyone thinks they're protected, but the protection only exists if everyone else remains solvent. Consider credit default swaps, those instruments that Warren Buffett famously labeled weapons of mass destruction. With $55 trillion in notional value, they function like insurance policies on corporate and sovereign debt. But unlike real insurance, there's no requirement for the sellers to hold adequate reserves. They're selling hurricane coverage with empty pockets, betting that the hurricane will never come. The mathematics are terrifying. If just 10% of credit default swaps were triggered simultaneously, the system would face payout obligations exceeding $5 trillion. That's more than the GDP of Germany. And the institutions that sold this protection don't have $5 trillion sitting in reserve accounts. They have maybe a few billion in capital, leveraged 50 or 100 times over. When the storm hits in 2026, these sellers won't just default on their obligations. They'll vanish entirely, leaving buyers holding worthless contracts and facing the full brunt of losses they thought were insured away. The cascade effect will be immediate and global. The foreign exchange derivatives market presents another vector for systemic collapse. Currency swaps and forwards represent $97 trillion in hidden exposure, mostly kept off balance sheets where regulators can't see them. These contracts assume that major currencies will maintain relatively stable relationships with each other. But when crisis hits, currencies don't move in orderly fashion. They spike and crash in violent waves that destroy carefully calculated hedges. We witnessed this dynamic during the 2022 British pound crisis. When the UK government announced unfunded tax cuts, the pound collapsed against the dollar, forcing massive margin calls on currency derivatives. Pension funds that had used these instruments to hedge their foreign investments found themselves facing bankruptcy within hours. Only emergency intervention by the Bank of England prevented a complete meltdown of the British financial system. Now imagine that scenario playing out simultaneously across dozens of currencies, with central banks too overwhelmed to intervene effectively. The dollar-euro exchange rate, the yen-sterling cross, the yuan-dollar relationship, all of these could become battlegrounds where derivatives positions explode in unpredictable directions. Commodity derivatives add another layer of complexity. Energy, agricultural and metal futures represent trillions in additional exposure, all tied to physical markets that can experience supply shocks. Russia's invasion of Ukraine demonstrated how quickly commodity prices can spike when geopolitical events disrupt supply chains. Natural gas derivatives in Europe faced margin calls that exceeded many institutions' total capital. Wheat futures spiked so violently that agricultural derivatives nearly triggered a broader crisis. The interconnections run deeper than most people realize. A bank that sells credit protection through default swaps might hedge that exposure with interest rate derivatives. Those rate derivatives might be backed by currency swaps to manage foreign exchange risk. The currency swaps might reference commodity prices to account for inflation. Each layer adds complexity and creates new failure points. When one link in this chain breaks, the entire structure becomes unstable. A sovereign default triggers credit derivatives, which forces interest rate adjustments, which destabilizes currency relationships, which affects commodity prices, which feeds back into sovereign debt sustainability. It's a perpetual motion machine designed to amplify rather than absorb shocks. The shadow banking sector has become the primary accelerant for these risks. Money market funds, hedge funds, and private equity firms operate with minimal oversight while holding enormous derivatives positions. They borrow in short-term markets to fund long-term bets, creating the same maturity mismatches that destroyed savings and loans in the 1980s. But their scale dwarfs anything from previous decades. Pension funds, supposedly the most conservative institutional investors, have become derivatives addicts. Seeking higher returns in a low-interest environment, they've piled into complex strategies that promise steady income but hide massive tail risks. UK pension funds nearly collapsed in 2022 when their derivatives strategies backfired. American pension systems, facing similar pressures, have adopted similar strategies with similar risks. When these institutions face margin calls in 2026, they won't have the luxury of waiting for markets to recover. Pension obligations continue regardless of market conditions. They'll be forced to sell assets into falling markets, accelerating the very declines that triggered their problems. It's a classic liquidity spiral, but on a scale that could consume entire national retirement systems. The technological infrastructure that supports derivatives trading has become another source of systemic risk. High-frequency algorithms execute millions of trades per second based on mathematical models that assume normal market conditions. But when markets turn abnormal, these algorithms don't pause to reconsider. They continue executing pre-programmed strategies that can amplify volatility beyond human comprehension. Flash crashes have become routine in individual stocks and commodities, but derivatives markets, with their massive leverage and tight interconnections, could experience flash crashes that destroy institutions in minutes rather than hours. Circuit breakers and trading halts provide little protection when the underlying problem is structural insolvency rather than temporary panic. Artificial intelligence systems, now deployed across major derivatives desks, add another layer of unpredictability. These systems learn from historical data, but they've never experienced a true systemic crisis. Their responses to unprecedented market conditions could amplify human panic rather than provide the stabilizing influence their designers intended. The $600 trillion derivatives market isn't just too big to fail, it's too big to save. When the mathematical certainty of 2026 arrives, no government bailout will be large enough, no central bank intervention swift enough, and no regulatory response adequate enough to prevent the cascade. History doesn't repeat, but if you ignore these warnings, the collapse will crush you all the same. The only protection is preparation. The only defense is understanding what's coming before it arrives.